Over the past week, the Forex market experienced notable volatility influenced by geopolitical developments, central bank actions, and economic data releases. US dollar dynamics. The US dollar strengthened early in the week amid renewed concerns over President Donald Trump's tariff plans. Trump threatened tariffs on Colombia for not accepting military flights carrying deportees. Although the situation was resolved with Colombia agreeing to accept these flights, it elevated tariff risks. The Mexican peso and Canadian dollar weakened due to these threats, while the euro and sterling also saw slight declines. The dollar index remained near a one-month low. The Federal Reserve is expected to maintain interest rates, with investors looking for indications of future rate cuts. U.S. 10-year bond yields fell amid these economic shifts. Impact of DeepSeek on markets. A significant sell-off in technology shares led to a $1 trillion loss in U.S. stock markets, primarily due to a 13% plunge in Nvidia shares, marking the largest such loss in U.S. market history. This was triggered by the popularity of a new AI app from Chinese startup DeepSeek, raising concerns about the future dominance of U.S. technology companies. Stocks of other major tech companies like Microsoft, Meta Platforms, and Alphabet also fell significantly. Despite initial heavy losses, U.S. markets partially recovered later in the trading day. Sterling's mixed performance. The British pound exhibited mixed movements, remaining relatively stable against the euro and dollar but falling sharply against the yen. Investors focused on upcoming economic data and central bank policies. The pound had previously rallied against the dollar following comments by President Trump suggesting a potential softening of tariffs, though trade policy concerns resurfaced. The Federal Reserve and European Central Bank are set to announce rate decisions, with the Fed expected to hold rates steady and the ECB possibly cutting rates by 25 basis points. Bank of Japan Governor Kazuo Ueda signaled ongoing interest rate hikes, contrasting with the more accommodative stances of other central banks. Sterling fell 0.94% against the yen, stood down 0.1% at $1.2484 against the dollar, and marginally dropped 0.04% against the euro to 84.01 pence per euro. Analysts at BofA remain cautiously optimistic about sterling while noting increased downside risks. Tariff concerns and currency volatility. The dollar strengthened against the yen and euro due to new U.S. tariff threats. President Trump plans to impose tariffs on computer chips, pharmaceuticals, and steel to incentivize domestic production. This announcement followed a resolution with Colombia regarding military flights carrying deportees. The strategist Sim Mo Siong from Bank of Singapore noted that tariff news has caused a whiplash effect in dollar movements. The dollar index increased by 0.08% to 107.89. Trump also indicated possible 25% tariffs on imports from Canada and Mexico starting February 1, as well as on the EU and China. The yield on 10-year U.S. Treasury bonds recovered after a previous decline. The yen and other currencies also experienced significant movements due to tariff speculation and monetary policy developments. Upcoming meetings of the Federal Reserve and the ECB are anticipated to be key in defining future economic policies and interest rates. Central bank actions. The Bank of Japan hiked rates by 25 basis points to 0.5%, bringing its policy rate to its highest level since 2008, as it seeks to normalize its monetary policy. These developments underscore the Forex market's sensitivity to geopolitical events, central bank policies, and economic indicators. Traders are advised to monitor these factors closely to navigate the evolving landscape. As we approach the week of February 3 to 7, 2025, the Forex market is poised to react to several key events and economic indicators. Here's an overview of anticipated developments and a fundamental analysis to guide your trading strategies. Key events for the upcoming week. Federal Reserve meeting, February 5. The Federal Reserve is scheduled to announce its interest rate decision. While the consensus leans towards maintaining the current rates, traders will closely monitor the accompanying statement for insights into future monetary policy directions. Bank of England rate decision, February 6. The Bank of England will reveal its interest rate decision. Recent dovish sentiments within the Monetary Policy Committee suggest a potential rate cut, with markets anticipating a 25 basis point reduction. U.S. non-farm payrolls, February 7. The U.S. labor market report will provide data on job creation, unemployment rates, and wage growth. Strong figures could bolster the U.S. dollar, while weaker numbers might exert downward pressure. Fundamental analysis and trade considerations. U.S. dollar, USD. The USD has recently strengthened due to renewed tariff concerns and expectations of a steady Federal Reserve policy. However, any unexpected dovish signals from the Fed or disappointing labor market data could reverse this trend. British pound, GBP. The GBP's trajectory will largely depend on the Bank of England's decision. A rate cut could lead to a depreciation of the pound, especially against currencies with more hawkish outlooks. Euro. The euro remains under pressure due to concerns over economic growth within the Eurozone. The European Central Bank's focus has shifted from inflation to growth, indicating potential monetary easing in the future. Potential trade setups. Euro to US dollar. Given the contrasting monetary policy outlooks between the Federal Reserve and the European Central Bank, the euro to US dollar pair may continue its downward trend. Traders might consider short positions, especially if US economic data outperforms Eurozone indicators. Pound sterling to US dollar. If the Bank of England proceeds with a rate cut, the pound sterling to US dollar pair could face selling pressure. Monitoring the pair around significant support levels could present short selling opportunities. US dollar to Japanese yen. The Japanese yen has experienced volatility due to global trade tensions. A strong US labor report could propel the US dollar to Japanese yen higher, making long positions favorable. The upcoming week is laden with pivotal events that could significantly influence Forex market movements. Traders are advised to stay abreast of economic releases and central bank communications, employing sound risk management practices to navigate potential volatility.